Hey there, I'm John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about how to make sure you have enough retirement income if Social Security is not paying you enough. So this is very common with most retirees who are relying on Social Security as a valid source of income for their retirement. I mean, you've paid a lot of money into this program, and a lot of times the payouts are just not what you need for retirement, especially when you compare it to the earnings that you're used to making versus what you really need to have during retirement. And a lot of times we think, well, we only need like 70 or 80% of our average salary to live on for retirement. And that may be true. But at the same time, you might have extra costs such as healthcare. Maybe you want to travel some more. I mean, there's other hidden costs. I mean, even just taking care of the house, people don't realize it can just be expensive. And so I always recommend get as much income as you possibly can for retirement. And of course, I look at annuity contracts to do that. I like using guaranteed income sources to supplement Social Security, because Social Security really is an annuity. It's very similar to a pension. Pensions are annuities, and annuities are just when you're looking for lifetime income, they provide that stable income that you can rely on for the rest of your life, no matter how long you live. I just want to talk about that because if you're relying on Social Security, but you have maybe a 401k or an IRA, or just maybe you have money in a savings or brokerage account, or even sometimes people have old rentals or real estate that they want to sell and they just want to turn it into some income, an income that they don't have to worry about managing. Okay, that's the other thing about lifetime income is it passive? Is it truly passive? Or is it something that you have to take an active role in making sure that continues to you? So especially if you're married and you're worried about your spouse and you don't want them to have to worry about it if something happens to you and they're older, annuity contracts can be very valuable for that. So I'm going to share my screen so you can see what these can do for you. And we'll look at different scenarios, but I would invite you to go to my calculators. They're on my website, johnstevenson.com, and I have all of the annuity solutions on there. So if you want to plug in your own information and figure out what would be the best annuity for you, feel free to do so. It will ask for your email, but that email just is used to send you the quote. I'm not going to reach out to you unless, of course, you want some help purchasing an annuity. So anyways, all right, I'm going to share my screen. I want you to see someone that I just helped. They're in Vermont. They're 62 and they're married. So their spouse is 60 years old and they're using $100,000 and they want lifetime income to start right now. So they've started Social Security payouts right now. They decided to take it at 62, and then they also wanted income from $100,000. So their Social Security is around $40,000 a year, and they're wanting to see how much. I mean, $100,000 isn't all that they have, but they want to see, all right, well, we want some more income. Now it just kind of remains to be seen how much we need to invest to support the lifestyle we want. All right, so, and it's a joint payout. And joint payouts are basically if you want lifetime income to continue to your spouse when you pass away, even if the account balance is at zero. That's really important. Okay, so looking at this, $100,000 looks like the highest payout for this couple would be $6,500 per year for the rest of their lives. Now, that's not bad when you look at the payouts over 30 or 40 years. That can be pretty substantial. Now, this might be something that they would want immediate, and you can see this is what the payouts are for immediate, but they also might decide to defer it out, and if they defer it, of course, they're going to get more income from the same $100,000. So if we look at that and say, all right, well, that's Prudential. You got Gillico, you got Corbridge, Athene, F&G. You got lots and lots of different companies out here that will give you a guaranteed payout. But if you want to defer this out, maybe they're fine with taking Social Security at 62, and then maybe they're working part-time until 65, and they want to start taking out more income from an annuity at that point, and they want to completely retire and not have to work at all anymore. So if that's the case, then we'll just pull this out to 65. So of course they're going to get more income. We'll see what it's going to be here. All right, so $8,500 per year. So that's definitely an increase. And Prudential is not the highest for deferred. They're down here 8116, but Corbridge is excellent when you're looking for deferred income. And it's just because they're given a pretty decent roll-up rate to give that to you. So that's not bad. Now, you might be thinking, well, that's still not enough income, John. I've got more money than that. I would like to buy more income. Well, that's fine. We'll raise it up quite a bit here. So 500 grand definitely will give you more income. And if you defer it out for a few years, it gives you more than what you would get as an immediate payout. So $500,000. All right, now we're talking. So $42,000 a year, that might match or exceed what you're taking out for Social Security. And so maybe this is enough. Maybe if your Social Security is 40 grand and this is 42, $80,000 coming in guaranteed for the rest of your life. That's really nice, especially if this isn't all of your portfolio and you're thinking, well, I'd like to put some money into an annuity contract to guarantee me income and my spouse, and then I'll let the rest of my money ride in the market because I want some growth and maybe purchase more annuity contracts down the road to increase my income. That's a great strategy, and it's used by a lot of people. Now, looking at the details of this, I will show you exactly what the income looks like and also your account balance, because the account balance does not last forever. Okay, so if we look at the guaranteed side, guaranteed is worst case scenario. That means if the underlying index, and the index does not determine the income, by the way. Okay, I get this question a lot. The index only determines how long the account balance lasts and therefore your death benefit, which you can see right over here. The death benefit will go down over time with your withdrawals. Okay, so we'll go back here and we'll say, okay, well, worst case scenario, if there's no index growth, and this is, the underlying index for this is the S&P 500, and they're only giving you a small portion of it. They're buying call options, and they're just giving you a portion of the earnings that they get from that if they exercise the call options. So that's all that's for. It's for keeping the account balance as high as possible for as long as possible for the death benefit. But the income is already assured. That is guaranteed. That is contractual. So if we look at this and say, all right, well, if we wait 3 years, that's $42,670. But of course, if you decide to change your mind and you wait 1 year, you can see over here under the available lifetime withdrawal column, it says 35 grand. Or if you wait 2 years, it's almost 39,000. And then of course, 36 months, it's 42,670. So if you look at that and say, okay, well, that's pretty good income. And even if the account balance runs out, the income continues. And this is really important because if it runs out and you die, if you're on a single payout, that income stops. Okay, so you want to make sure you select a joint payout if you're married. Unless your spouse is like 20 years younger, then a lot of times what they'll do is they'll have separate assets and they'll purchase different contracts for that. All right, so now if we go down and we look at the hypothetical just shows you here's what happens if you earn 4%, because right now they're capping your participation at 4%, the participation that you have in the S&P index. So if you look at that, then your account balance lasts a few years longer, but that's about it. It still will maybe last till maybe 78 years old. But at that point, it's still going to be out. And if you die before then, you and your spouse both die, of course that account balance will be the death benefit. As you can see over there, that death benefit does pay out, whatever you haven't used up pays out to your beneficiaries. Okay. So, but if we go down and we look at the total payout till you're 95, it's like $1.3 million. That's really good. So what you're doing is you're purchasing a lifetime pension to complement and basically bridge the income gap that you're going to experience from what you need versus what you're receiving from Social Security. So that's a way to bridge the income gap. And a lot of people will do this even if they have Social Security, even multiple Social Security, from both spouses, and maybe a pension. Maybe it's still not enough. And you're just thinking, well, I've got $1 million in my 401k and I want to use 300,000 or 500 grand or whatever for lifetime income. You can do that. And it's a great way to secure lifetime income. And a lot of times what people do is they'll purchase a bunch of small contracts after this. They'll buy a big one like for the initial payout, and then what they'll do is they will purchase smaller contracts, like maybe $100,000 increments, and they will have those pay out. They'll increase that like every 10 years just to give them a raise. So let me just show you that real quick. So I'll just go back and I'll say, all right, let's say we got one for 500 grand, but then we decided to do two more for 100,000 each. But of course, we're not going to activate income on those until later. So this is our plan to maybe combat inflation. There are inflation riders for other types of annuities that you can use, but you just have to remember for any inflation product, if you have that tied to it, they start your initial payout much lower. So a lot of times what people would rather do is buy multiple contracts, and then they will decide later on when to actually turn on those income payments. All right, so if I pull this out, let's say to 73. Okay, 73, so they already started income at 65, and then they decided to wait several more years, and then they turn on income from the 100,000. Well, if you look at that, that's pretty substantial. ClearSpring is paying out $17,375. So that's a pretty good rate. So you just added almost $1,500 a month to your income. Okay, but you still got the other $100,000 policy riding, and maybe you're thinking, well, I will use this much later because if my spouse dies, I want to be able to replace their Social Security payout that I won't get anymore. Okay, so let's say you bring this out to 83. 83 is still kind of young. It's definitely under the life expectancy, but if we look at that and say, well, I put 100,000 in and I let that thing grow for 21 years, what will 100 grand give me then? No, $30,000. Pretty good. You can pretty much get all your principal back in 3 years. That's pretty good. And then, of course, the rest of it's gravy. So I love that. And this one is with American Equity, and their payouts are really competitive just because their roll-up rate is for such a long period. So if you look at that, you look down here, you'll see, all right, well, how do they decide this? Well, it's because the roll-up rate, the 6.5% that it's been earning for 20 years, plus the 10% bonus, has created a large benefit base. I mean, it's $387,601. In fact, you'll notice here, it's probably be better just to take it at like 81 because you can see the lifetime withdrawal rate doesn't go up after 81 either. So I would just say take it at 81 because 387 grand multiplied by 7.78 gives you $30,000, 155 guaranteed for the rest of your life and your spouse's life. So if you take that out for like even 10 years, okay, it's pretty good. That's $300,000, 15 years, $450. So it's a great way to secure lifetime income and to replace maybe a gap that you might experience if you lose the other person's pension or Social Security payout. So anyways, hope this has been helpful. If you're looking to purchase an annuity and you want to bridge the income gap that you might experience between what you're getting from Social Security or a pension versus what you need, and you have funds, maybe from a 401k, IRA, or a brokerage account, and you're just thinking, hey, I'd like to create some lifetime income for myself, then go to my website, johnstevenson.com. You will see my annuity calculators there. Check out the income rider. Typically, it pays out the most, but you got the SPIA and DIA and QLAC quotes as well. So it just depends on your situation and what you're looking for. And even the MIGA calculator is great for fixed rates. It doesn't give you lifetime income, but it absolutely will give you some fixed payouts for a certain term or a certain amount of period of time. So if you're looking like 3, 4, 5 years or 10 years, whatever you're looking for, that's what it'll pay out. Okay. So if you're looking to purchase an annuity, you can then book a call with me on my website, or you can book a call on the link below this video and it'll go directly to my calendar. And I'd love to help. So I'll answer your questions, and if you're looking to purchase, I'd love to help you. And I'm not going to try to hard sell you, strong arm you into anything. No one likes being sold. So I will answer your questions though. And if you like the video, I hope you like, subscribe, share, comment below. I will absolutely answer those questions. I appreciate you watching, and we'll see you next time.